Last Tuesday at 11:17 a.m., something fundamental broke. It wasn't a stock or a bank, it was a relationship. For 47 minutes, U.S. Treasury bonds, the supposed bedrock of global finance, ceased to act as a safe haven. They sold off violently, in lockstep with a plunging S&P 500. Financial headlines dismissed it as a technical dislocation. But that precise anomaly, a correlation breakdown between stocks and treasuries, has only appeared a handful of times in a century. And, on each historic occasion, it was the final, ignored tremor before a catastrophic collapse. The data from that Tuesday paints a terrifying picture. The ICE BOFA Move Index, which measures volatility in the Treasury market, spiked 22% intraday. Simultaneously, the equity VIX fear gauge surged 18%. Most damningly, the yield on the 2-year Treasury note, the most sensitive to Fed policy, jerked 18 basis points in just 30 minutes, a move equivalent to weeks of normal trading. This tandem panic in supposedly opposing assets is the ultimate canary in the coal mine of systemic stress. The market recovered by the closing bell. Pundits called it a healthy correction. But in the ticker tape archives of 1929 and the server logs of 2008, this exact same signal flashed bright red, dismissed by contemporaries as a one-off, non-fundamental event. They were measuring the wrong thing, company earnings, while the market's very plumbing was fracturing. This raises the critical questions. What is this hidden signal? Why does simultaneous panic and risk on stocks and risk off treasuries predict systemic failure, not just a bad day? And why is it flashing with ominous regularity now? The answer lies not in economics, but in the hidden pressurized plumbing of the financial system. To understand it, we must go back to the moment that plumbing first explosively failed. In 1929, the warning signal wasn't on the stock ticker, it was in the money markets. The fuel for the historic bubble was call money, overnight loans that stockbrokers used to finance margin purchases. In the critical weeks of September 1929, this rate didn't just climb, it went berserk, skyrocketing from 7% to a paralyzing 20%. But the true signal was broader. As Federal Reserve data shows, other supposedly stable short-term credit rates like those for commercial paper also jerked violently. The entire system for short-term corporate and speculative financing was seizing. This was the 1929 version of stocks and treasuries falling together. The signal wasn't that stocks were overvalued, that had been true for years. It was that the very mechanism for financing their ownership was breaking down. Volatility had jumped from the risky assets, equities, to infect the supposedly safe, short-term credit that underpinned the entire economic edifice. The correlation breakdown was between broker loans and general commercial credit, revealing a systemic infection. As economist John Kenneth Galbraith later wrote of that period, the market was not reflecting the business prospect for the period immediately ahead. It was reflecting the prospects for the further increase in the value of common stocks. The fatal signal appears precisely when the speculative logic dies, and the market's focus abruptly shifts from the future value of assets to the immediate safety and availability of the money itself. The critical point is this. October 24th and 29th, Black Thursday and Black Tuesday, were the catastrophic explosions. The clear, documented warning was the bizarre, unstable behavior of money market rates throughout September. The lubricant of the financial system, short-term credit, was turning to sand. The documented public fixation on the falling Dow Jones masked the verified prior panic in the credit markets that made the collapse inevitable. This identical signal returned with technological fury in 1987. But its purest, most instructive modern appearance, a direct mirror to 1929's money market seizure, was in the fall of 2008, when the plumbing of the 21st century froze solid. In 2008, the warning signal materialized in the repurchase agreement, or repo market, the modern lifeblood of Wall Street, where institutions borrow cash overnight against Treasury collateral. In mid-September, this system didn't just slow, it suffered a cardiac arrest. The telltale sign was the Treasury fail rate, the failure to deliver even risk-free treasuries in a transaction, skyrocketing. Institutions were so terrified of counterparty collapse, they wouldn't hand over the world's safest asset. The data is stark. On September 15th, 2008, the day Lehman Brothers failed, the spread between general collateral repo rates and Treasury bill yields, normally a tight few basis points, exploded. Simultaneously, Treasury yields themselves began gapping wildly in intraday trading. The safe asset was in panic. As research by economist Arvind Krishnamurthy shows, this was the moment the plumbing burst. This crystallized the liquidity divergence signal. The Move Index Treasury volatility and the VX equity volatility spiked in terrifying unison. When U.S. sovereign debt itself becomes violently volatile, the system is no longer questioning the value of mortgage bonds or bank stocks. It is questioning the solvency and trustworthiness of every single counterparty in the financial network. Cash becomes the only king, and even treasuries are viewed with suspicion. The moment was captured by author Andrew Ross Sorkin in Too Big to Fail. Treasury officials watched in real-time horror as a routine Treasury auction threatened to fail, a surreal event signaling that the fundamental architecture of trust, the ability to transact in the foundational asset of global finance, had vanished. The documented public narrative of a subprime mortgage crisis masked this verified reality of a core funding and collateral crisis that infected even sovereign debt. We saw this signal again, briefly and violently, in the dash for cash of March 2020. And then, last Tuesday, the same arrhythmia appeared on the financial EKG. The reason is simple. The same patient, a financial system built on extreme leverage and fragile, trust-based plumbing, is suffering from the same chronic disease. The recurring signal points to a hidden structural flaw in modern finance, the liquidity mirage. Today, liquidity is measured by daily trading volume. Trillions change hands. But true liquidity is the presence of a committed buyer at a stable price during a crisis. In our electronic markets, that liquidity is primarily provided by algorithmic, high-frequency market makers. Their code is programmed to withdraw the moment volatility spikes beyond certain parameters to avoid losses. They provide liquidity on sunny days and vanish in a storm. This mirage is supercharged by a mechanical volatility feedback loop. Here's how it works. 1. Stocks begin to sell off. 2. Systematic strategies like volatility targeting and risk parity funds, which manage trillions, are hardwired to delever when volatility rises. 3. To delever, they sell not just stocks, but also the bonds in their portfolios. 4. This forced indiscriminate selling in the Treasury market creates a volatility in that supposedly safe asset. 5. Rising Treasury volatility then triggers more delevering from other systematic strategies, connecting the two asset classes in a self-reinforcing death spiral, as documented by the Fed and BIS in their analysis of the 2020 dash for cash. Further risk is concentrated in the belief that exchange-traded funds, ETFs, provide liquidity. They provide tradability for the ETF share itself, but the underlying assets, thousands of corporate bonds, can be deeply illiquid. In a crisis, the ETF price can decouple violently from the value of its underlying holdings, triggering a fire sale in the ETF that then forces fire sales in the already illiquid bonds, accelerating the panic. So, what likely happened last Tuesday? A moderate equity sell-off likely triggered the first wave of systematic delevering. Algorithmic market makers in the Treasury market, seeing the volatility spike, automatically widened bid-ask spreads and pulled their orders. For 47 minutes, there were no reliable, committed bids for safety. With the buyer of last resort, the algo, gone, even Treasuries fell. The signal wasn't about economic news. It was a real-time stress test of a brittle, algorithmic market structure. The signal flashes when the system's hidden leverage meets its illusion of liquidity. 1929 had broker call loan leverage. 2008 had repo and derivative leverage. Today has ETF, systematic strategy, and private fund leverage. This signal doesn't predict a crash next week. It diagnoses a chronic condition, acute systemic fragility. The countdown to a crisis begins when a fundamental economic or geopolitical catalyst strikes this already fragile structure. The initial correlation break is not the crisis itself. It is the tripwire that triggers a predictable 5-stage cascade toward systemic freeze based on the blueprints of 2008 and 2020. Stage 1, the divergence signal. This is the last Tuesday event. Stocks and Treasuries fall in unison, signaling a breakdown in the basic hedging relationship and the onset of a pure liquidity scramble. Stage 2, funding stress. The panic infects the short-term credit markets. Money market funds face massive redemptions. Repo rates spike and become unavailable for certain collateral. The commercial paper market, where companies fund daily operations, seizes, as it did in 2008. Stage 3, forced fire sales. To meet investor redemptions, margin calls, and fund operations, institutions sell whatever they can sell, not what they want to sell. This dumps immense, indiscriminate volume onto the market, causing prices of even high-quality assets to plunge far below fundamental value. Stage 4, counterparty gridlock. Trust evaporates entirely. Banks, unsure which counterparty is next to fail, hoard cash and cease lending to each other. The system for distributing and financing collateral breaks down. The financial network suffers a stroke. Stage 5, central bank intervention. As the dealer of last resort, the Federal Reserve is forced to step in, creating emergency facilities to buy the assets no one else will, commercial paper, municipal bonds, corporate ETFs, and lend directly against frozen collateral, attempting to unfreeze the plumbing. The critical window for catastrophic price discovery lies between Stage 1 and Stage 5. The signal provides that window, historically between 2 and 8 weeks. In 2008, the signal was blazing in early September. The system locked up by mid-September, and the full government response, TARP, was not announced until October. This sequence is inevitable because the modern system is a dense network of promises, loans, derivatives, margin agreements, all backed by the assumed stability of underlying asset values. When the value and liquidity of the safest assets, Treasuries, become uncertain, every single promise in that network is questioned simultaneously. The entire machine jams. Therefore, if we witnessed the stage 1 signal last Tuesday, the pressing question becomes, what fundamental catalyst now serves as the match to this structural tinder? The stage 1 signal revealed the system's acute fragility. Any of several plausible I-24 catalysts could now strike that exposed nerve, triggering the full cascade. Catalyst A, commercial real estate, CRE, mortgage reckoning. Over $1 trillion in CRE debt matures in 2024-2025. The core problem, the underlying collateral, especially office buildings, has depreciated sharply, but the loans were made at peak values. Banks, particularly the regional banks holding the majority of this debt, are unwilling or unable to refinance. A major default or a publicly traded RIT collapse could ignite the first wave of forced selling and intense counterparty fear, directly impacting bank balance sheets. Catalyst B, private credit, mark to myth, crisis. The massive, opaque $1.7 trillion private credit market values its loans internally using models, not public market prices. This creates an illusion of stability. A few high-profile defaults in highly levered companies could force a sudden industry-wide mark-to-market reckoning. This would reveal steep losses, triggering investor redemptions in funds that only offer liquidity quarterly, leading to a violent rush for a non-existent exit. Catalyst C, Treasury market to buyer's strike. The U.S. government must finance massive deficits. Traditionally, the Federal Reserve, foreign central banks, and domestic banks were reliable buyers. Now, the Fed is shrinking its holdings, quantitative tightening, foreign buyers are diversifying, and banks are saturated. A single poorly received Treasury auction, a tail event, could spark a self-fulfilling sell-off in the benchmark asset itself. Since all other assets are priced relative to Treasuries, this would instantly trigger the divergence signal globally. Catalyst D, the everything, overvaluation, and exhaustion. The simplest catalyst, a sharp deterioration in corporate earnings against a backdrop of historically high equity valuations. If TINA, there's no alternative, flips to TARA, there are real alternatives. The initial equity sell-off could be severe enough on its own to trigger the automated cross-asset delevering of systematic strategies, creating its own liquidity vortex. The common thread across all catalysts is identical. Each threatens a sudden, discontinuous repricing of an asset class that is deeply woven into the financial fabric via leverage, derivatives, and assumed stability. The system's wiring interprets such a repricing not as a routine valuation adjustment, but as a potential solvency event for anyone holding that asset, immediately activating the contagion sequence. The documented market focus remains on quarterly earnings and the Fed's next rate move. But the verified lurking risks are in these opaque, leveraged corners of credit and rates. The Federal Reserve is acutely aware of this. Its emergency playbook, written in 2008 and updated in 2020, is ready. But deploying it this time presents an insurmountable new problem, the utter erosion of its credibility. When the divergence signal escalates into a full-blown crisis, the Federal Reserve will face a policy trap of historic proportions. Its 2008 to 2020 playbook is clear: slash rates to zero, launch unlimited quantitative easing, QE, and open emergency lending facilities. But in 2024 or 2025, this textbook response is politically and economically impossible. The dilemma: inflation remains stubbornly above the Fed's 2% target. Cutting rates to zero and restarting QE would constitute an immediate, total surrender in the inflation fight, annihilating central bank credibility and risking a permanent loss of currency confidence. The Fed is trapped between its mandate for price stability and its duty to ensure financial stability. The likely response will be a slow, Kafkaesque compromise. 1. Targeted bailouts, creating a commercial real estate liquidity facility or a private credit stabilization fund, explicitly picking winners and losers. 2. Slow motion, camouflaged QE, purchases framed as smoothing market functioning rather than stimulus. 3. Verbal intervention and hope, attempting to jawbone confidence back into the system. This piecemeal, hesitant approach may fail to restore the systemic trust needed to halt a crisis, potentially prolonging the contagion. This will ignite a political firestorm. Any perception of a bailout for banks, private equity, or commercial real estate tycoons will be politically toxic in a polarized environment. The Fed's cherished independence will come under unprecedented attack from both the left and the right, rendering its actions slower, more conflicted, and less potent than in 2008. The worst-case outcome is the convergence of a 1970s-style inflation crisis with a 2008-style financial crisis, true stagflation with a frozen credit system. This doom loop, where price pressures prevent a rescue while the financial seizure deepens the economic downturn, is the catastrophic scenario the divergence signal now warns about. The contrast between the documented blind faith in the Fed put, the belief the central bank will always backstop markets, and the verified reality of a Fed with constrained tools, shredded credibility, and conflicting mandates has never been starker. This fundamental shift changes the calculus for every single investor. The old rules of buy the dip and don't fight the Fed are not just risky, they are obsolete. The recurring signal and the crises it precedes are not random. They are the mechanical validation of economist Hyman Minsky's financial instability hypothesis, a timeless framework that explains why capitalism is prone to collapse. Minsky outlined 3 stages of finance in a cycle. Hedge finance. Borrowers can repay both interest and principal from their income. This is a stable, healthy system. Speculative finance. Borrowers can only pay the interest, not the principal. They depend on continually rolling over their debt. Ponzi finance. Borrowers cannot even cover the interest payments. Survival depends entirely on the perpetual appreciation of the asset prices used as collateral, allowing for endless refinancing. The liquidity divergence signal is the moment the market collectively realizes the system has tipped into Ponzi finance. U.S. Treasury bonds represent the ultimate hedge asset, backed by the full faith of the government. When they become violently volatile in tandem with risky assets, it is a scream that the entire financial structure has become dependent not on fundamental cash flows, but on perpetual asset inflation and unshakable trust. The foundation itself is cracking. This realization is the Minsky moment. It is not the crash itself, but the instantaneous, terrifying recognition that the prevailing mode of finance is unsustainable. Last Tuesday's 47-minute anomaly was a micro-Minsky moment for the algorithms, a fleeting digital realization that the system's assumptions were broken. This repeats because, as Minsky observed, stability is destabilizing. Long periods of calm and rising asset prices, like 2009 to 2021, encourage more leverage, more complexity, and riskier behavior. This slowly but inevitably rebuilds the speculative and Ponzi structures until the next signal flashes. Or as Minsky put it, success breeds a disregard of the possibility of failure. The signal is the cold, sudden return of that possibility. This framework transforms the eerie parallels with 1929 and 2008 from coincidence into inevitable recurrence. It also provides the critical lens for what to watch next, not just asset prices, but the quality of credit and the dependency on refinancing across every sector of the economy. The next true Minsky moment will arrive when a critical mass of debt shifts from the speculative to the Ponzi category and the market finally sees it. The modern parallel to 1929 stocks and 2008's housing is the everything bubble, inflated by 14 years of cheap debt and relentless financial engineering. The bubble is diffuse in venture capital unicorns, in private equity portfolios bought with record leverage, in meme stocks and cryptocurrency, in luxury real estate, and in sectors of the public stock market trading on distant future promises. The common fuel is financial engineering and liquidity ignorance. The proliferation of structured products, the embedded leverage in certain ETFs, and the alchemy of turning illiquid private company shares into stable, NAV-based funds all rest on a single dangerous assumption, that market liquidity is perpetual and deep enough to absorb any selling. Last Tuesday's signal was a direct, real-time challenge to that core assumption. For 47 minutes, the liquidity vanished. The critical difference this time is diffusion. The bubble doesn't have one clear epicenter like 1929's call loans or 2008's subprime mortgages. This means the unwinding may not be a single, catastrophic crash, but a serial deflation, a longer, grinding collapse that manifests as a series of Tuesday-like events growing more frequent and severe, popping one overvalued sector after another as contagion jumps through the interconnected plumbing. Therefore, the canary to watch today is not just the S&P 500, it is the specific, leveraged corners of the system, the quarterly reports of private credit funds for sudden loss provisions, the CMBX indexes tracking commercial mortgage-backed securities for widening spreads, the term structure of the VIX for persistent inversion. When acute stress appears in these opaque areas and coincides with Treasury market volatility, the MOVE index, the divergence signal is receiving powerful multi-point confirmation. The crisis is transitioning from a potential to a process. This stands in stark contrast to the documented celebration of broad market resilience and climbing a wall of worry. The verified reality is the systematic diffusion of risk into the least transparent, least regulated, and most leverage-dependent parts of the financial system. This leads to a final, actionable insight. The signal is not a prophecy of a specific date. It is a diagnostic tool revealing systemic fever. And in 2024, that diagnosis demands an entirely new investor and policy playbook. The signal from 1929, 2008, and last Tuesday is not for day trading. It is a regime change indicator. It announces a shift from an environment of stable expansion to one of fragile instability. Surviving this new regime requires a new rulebook. Rule 1, prioritize liquidity over yield. Shift a meaningful portion of your portfolio to actual cash and short-term Treasury bills. In a systemic seizure, the goal is not return on capital, but the return of capital. Liquidity is optionality. Rule 2, delever immediately. Reduce margin debt, pay down variable rate loans. In a divergence event, falling asset prices and rising volatility magnify losses through leverage, creating an inescapable death spiral. Solvency is your first priority. Rule 3, question. Every assumption of liquidity. For every asset you own, an ETF, a private fund stake, real estate, ask brutally, could I sell this during a bad week without a 20% plus discount? Honestly, reprice your portfolio with a liquidity haircut. Rule 4, watch the plumbing, not the news. Monitor the MOVE index, Treasury volatility, repo rates, and key credit spreads, like the TED spread, more closely than earnings reports or Fed speeches. The crisis will manifest in this plumbing long before it makes headlines. The final verified historical insight is this. In every case, those who heeded the early warning in the money and bond markets saved themselves. Those who dismissed it as noise and kept staring at the rising stock ticker were financially ruined. The signal is the noise you cannot afford to ignore. Therefore, your call to action is simple. Create a 3-item dashboard, MOVE index, 3-month T-bill yield, TED spread. When these lines stop being smooth and start moving in jagged, synchronous spikes, it is not a trading signal. It is a warning to step back from the ledge. Last Tuesday wasn't the crash. It was the visible fault line. The earthquake is a matter of when, not if. Your job isn't to predict the precise second. Your job is to ensure you're built on bedrock, not on the fault line itself.